In this thrilling episode, let me reveal the truth about Nvidia. You have to wonder how quickly they climbed to be part of the trillion-dollar club. Its market cap has increased by 184.79% in 1 year. I say that is insane, so make sure to watch until the end. Nvidia's stock price soared 145% last year, adding more than $300 billion to its market value. The key question for this company is what the future will look like in 5 years. Your investment decision depends on your expectations for Nvidia's long-term performance. Do you want to buy, sell, or hold the stock? Let's start with the first step. I call it pop the hood. When I buy a used car, I check under the hood. So let's do the same for Nvidia and examine its financials. The financials reveal a fascinating story. The guidance is fantastic. The management expects some incredible results. There are many other impressive things to look at. For example, operating expenses are down 30%, which shows efficiency, and net income is up 26%, which shows profitability. Data centers are now Nvidia's main revenue source, generating $4.3 billion in sales. That's unbelievable. Most of Nvidia's revenue now comes from data centers. Who would have guessed that 10 years ago? There's a lot of good stuff here. Now, gaming is down 38%, which is expected as the company shifts from that area to hardware, software, AI, and data centers. That number, it's basically 100% up in automotive. Another impressive story, automotive only accounts for about $300 million out of the $7 billion they made. But that small segment is growing at 100% per year, indicating where the company is going. On the revenue side, it's not so clear-cut. The company did decline by 12.4% year over year, but it's still up quarter over quarter, and management forecasts 70% growth, so it doesn't matter that much to investors. The second step I want to talk about here is evaluating the balance sheet and the ratios. How attractive is the deal being offered? The company is currently trading at $440 per share. The question is, how fair is that price based on what we know today, like earnings per share, sales per share, and what's happening with the company's balance sheet? Let's see. Now, this might shock you, but Nvidia is very indebted. Now, this company has $5 billion of cash, but $12 billion in debt, which means that they have to pay off all this huge $12 billion debt in a period of high interest rates, and I don't know how long these high interest rates will last. If you ask the Fed, it will be a long time, and that's one warning sign you have to consider. The other warning sign is looking at the ratios. Nvidia is currently trading at a price-to-earnings ratio of 228. That is absolutely astonishing since Tesla is currently trading at 80. But if you look at forward price to earnings, which I think is a better measure in Nvidia's case, forward price to earnings is at 70, still pricey, but more reasonable and closer to Tesla. Another thing I want to look at is the price to sales ratio. Right now, they're trading at over 40, which is very high. Tesla is trading at 8. But again, look at the forward price to sales, and it's 25, still higher than Tesla, but much closer to reality than over 40. And sure, at 70 price to earnings and 25 price to sales, Nvidia is still one of the priciest companies in the market, but this is not financial advice and not a suggestion to buy or sell Nvidia stock. Here are my thoughts on why this might still make sense. And again, I'm not telling you what to do, but just listen to me. Look, this is not the same company that was known for gaming 15 years ago. They have moved on. They are leading the way in all the major technological trends for the next 15 to 20 years. Hardware, software, AI, data centers, self-driving cars. They are at the top of every one of these fields. Nvidia has about $1 trillion of untapped market potential to go after in the next 5 to 10 years between hardware and software for AI and data centers. It's going to bring in a lot of revenue. The quality is evident in everything Nvidia does. So that makes a lot of sense. But the question is, how much is it worth at $440 per share? So let's do a complete DCF analysis on this company and see where we stand with this company. And for that, we have to explain what DCF means. DCF stands for Discounted Cash Flow Valuation Model. Now, it's exactly what it sounds like. It takes all the money Nvidia will make over its entire life and puts it into one big pile. And that pile is the market value of Nvidia. Simple as that, we compare it to what's currently available in the market. And we see the difference. If our pile is much bigger than the pile in the market right now, then we say the company is undervalued. But if we get $600 billion and the company is trading at $1 trillion, then we say the company is overvalued. It's very, very simple. Now, what is that cash flow? What is that pile? Well, let me explain. The only trick is understanding how to bring future cash flows back to 2023. Now, the idea is simple. I can give you $1 today or $1 in a year. Which one would you pick? You would take the dollar today, right? Of course, $1 today is worth much more than $1 in a year. Same thing. If I owe you $1 million in 5 years, how much would you accept today to let me off the hook? 600, 700, 800,000? You would take less because you're reducing the risk of me disappearing, the risk of me going broke. A million things can go wrong, and you get to take the money right now. Put it in the stock market and make some money. Make 8% a year by just investing in the S&P 500, right? So how much do we reduce future cash flows when we bring them back to 2023 for Nvidia? Because every single company has its own risk level. That risk level depends on what this company is, what it does, how good it is, and so on. And that risk level is called the weighted average cost of capital or the discount rate, whatever you prefer. But the idea here is simple. I've done my calculation. It's on the screen right now, and we have 13%. So 13% per year is the discount rate for Nvidia. That means that 1 year from now, in July 2024, $100 of cash flow by Nvidia is worth $87 today. And for every year, we're going to do it again. So it depends on how many years we go into the future. We're going to use that 13% to lower the value. So now that we know the risk, we know how much we will discount future cash flows when we bring it back to 2023 for Nvidia. What are these cash flows? How much cash flow will Nvidia make in the next 5 to 10 years? For that, we need to know the expected future growth rate of Nvidia. There are a few ways to approach it. Number one, we can look at history. Historically, Nvidia is growing at 27% per year, but will history guarantee us any future results? I don't think so. Number two, you can go with analysts. Now, in my opinion, analysts don't know what they're talking about. So I'm going to ignore that right away. Number three, you can get management guidance, 70%. You can use that. But management is biased. Even Jensen Huang, one of the best CEOs in the world, is biased. Every single manager is biased towards their company. So that's not a good measure for us. I will use an objective measure to see how much money the company is putting back into the company and how good they are at using this extra investment. And that percentage will give me future growth, because if I'm buying more factories and equipment and am good at making use of this additional investment, my growth rate will be higher. If I'm not putting money back into my business, my growth rate will be lower, simple as that, objective and emotion-free. Otherwise, we'll just say 50 to 60%, and then our entire model is based on a guess and has no merit or objective basis to stand on. We're not going to do that. Now for that, we will use two formulas to see the range, which will be the worst case scenario of our DCF. These calculations will give us the first step, the worst case scenario, and then we're going to build from there on. And there are two methods to find that number. And remember, the formula is simple: how much money the company puts back into the business and how good the company is at using this capital. Now again, two ways. One is to look at the return on equity. Return on equity means net income divided by the company's total equity, and then that is multiplied by the retention rate. Retention rate means how much money stays in the company and how much is paid as dividends. That is how much and how good. So let's use 20% for that. Now, the other way is looking at the return on capital. It's a very complicated formula, but the idea is how much money I'm putting back in capex and change in working capital as a percentage of my earnings before tax, then subtracting the tax on that formula and multiplying that by my earnings before tax divided by the total invested capital, which means that the debt and the equity combined. That gives me a percentage of about 5.1%. Let's call it 5%. So the worst case scenario for us for this company is 5 to 20% growth for Nvidia. I know this surprises many people, but don't forget this is the worst case scenario. Number two, this is objectively how to do this. And everybody's thinking about that 70% growth rate, but hold on, this is the right way to start it. And if we start with this 13% discount rate and 5 to 20% on the growth side, we will have a share price that you won't like as an Nvidia investor. For 5% growth, the result will be $23 per share. For 20% growth, Nvidia is at $50 per share versus the current $440 per share. If you use a historical growth of 27%, the price per share will be $66. If you use the company's guidance of 70% growth per year, the share price is $287, which is still well below the $440. The only way we get to $440 per share is by applying an 85% growth rate on this company, which is even higher than the 70% Nvidia is forecasting for a company. 85% per year for the next 5 years is what you need to get from Nvidia to justify the current $440 share price. But that doesn't mean you shouldn't invest. If you like Nvidia, you like the products, the company, and the business model, there's a way for you to invest in this company without paying the extra high price on the share price that everybody's right now. You average your cost over time, buy more when the share price drops, and buy less when the share price goes up. So over the next 3 to 4 years, your average cost in Nvidia will be way closer to the bottom than the top. Making informed decisions in the stock market is crucial, and seeking professional financial advice is always wise. So, will Nvidia stock continue to skyrocket, or is it too risky to invest in at this stage? Let us know in the comments section below. And while you're at it, make sure to smash the like and subscribe buttons down below. I highly recommend watching this fantastic video if you want to know more about Mullen stock. Just click this video right here and enjoy. Thank you for tuning in, and stay tuned for more exciting content in the future.